Okay, welcome back, everybody. Today we're going to be wrapping up Chapter 2. I just wanted to point out one thing. I know I said Wednesday that I was going to have the homework for Chapter 1 and Chapter 2 posted that afternoon. I decided, since we're a little behind on homework, we only have 3 slides to cover today, so I think I was just going to do a quick little homework assignment today. That way we just catch up on homework today, and then you can just go in, type it in, and submit it later. That way it's done. Does that sound good? That way it's taken care of. So we'll start today. We'll just wrap up Chapter 2 PowerPoint, and then we'll just do a quick little question or two out of each chapter, and then, like I said, we just punch it in later, or I can just give the grade because I know it'll be done. So that'll take care of that, and that'll get us back on track. But you still need to get in there and make sure the quizzes are done on time. And like I said, I'll make sure you have time on that. Then hopefully moving forward, we can stay on track now that the semester's getting started. Okay, so let's just go ahead and wrap up this chapter we were on. Okay. So we left off with accrual accounting part 2. So once again, accrual accounting is the process of measuring and reporting the economic effects of transactions, events, and arrangements in the period in which they affect, or period in which they occur, right? Even though the cash flows may not occur it may occur in a different period. So we've established that, right? We know the cash basis part of accounting. We could have a transaction, but we might not even collect that money maybe to a different reporting period. It might be the following month, or it might be the following year. So once again, that's accrual accounting. We're more concerned when the events occur, not when the cash is coming in or going out. So I think we talked a little bit about accruals and defers a little bit. Accruals is where we know the economic effects are recognized in the current period, even though the cash flows will occur in a later period. And then the deferrals when cash flows occur in the current period, but economic effects will be recognized in a later period. And we made the differentiation amongst these with the accruals. We know we have stuff coming in, right? Like we've already performed our service, right? So someone owes us money, but we've accrued for that money coming in as like a receivable. And like we said, like with the deferrals is where, say someone has paid us in advance and we just defer that revenue, right, as a liability. So that's what we're talking about with accruals and deferrals. So principles of accrual accounting, the revenue recognition principle. So this determines the appropriate period in which a company creates economic benefits, which occurs when a company satisfies its performance obligations or promises within the contract with the customer. So the revenue recognition principle here under US GAAP, pretty much saying once you've satisfied all your responsibilities within the contract, you can count them as revenue, right? Because you've satisfied everything you need to. Because under accrual accounting, remember, it's not when the cash switches hands, it's just once you've satisfied it. Meaning, if the terms are for you to deliver it to their place, and and so many products, then once you've done that, then you can count that as revenue. The expense recognition principle determines the appropriate period in which a company has consumed economic resources and conducting business operations based on cause and effect. So this is often termed as the matching principle. And so we want to make sure that we're matching the revenues and expenses within the same period so we can truly see the actual strength of the company and the performance of the company. Immediate consumption, so difference between if we want to capitalize it or if we want to expense it. So if we have immediate consumption, obviously that means we're going to expense it, right? So it's going to hit our income statement. If we capitalize it, then we're going to carry it on our balance sheet and then recognize it over different periods through a systematic process of depreciation or amortization, whatever the relative asset is that we decide to capitalize. So immediate consumption, that's just being expensed immediately. The systematic and rational allocation over time, that's what we're talking about, like amortization and depreciation, because we know both those are non-cash expenses, right? So what do we mean by like a non-cash expense?
So, depreciation?
Yeah, or either or. We'll just stay with depreciation since that's the more common of the two that we see more often. So it's pretty much we've already spent the cash when we purchased the cash or whatever we've issued when we purchased the asset, right? So we've incurred that cost up front, but we're not expensing it. We're instead of just placing it as an expense on the income statement, we're going to place it on the balance sheet, right? And why do we do that in terms of fixed assets? What's the purpose in capitalizing a fixed asset? Think of expense recognition, the systematic and rational allocation over time. So what does that really mean? What's the theory behind us capitalizing these assets and then over time depreciating it into income, expensing it into income?
I guess it's more accurate to say you use it over time rather
Right.
than when you purchase it.
That's exactly right, because that, like if we buy a manufacturing piece of equipment, right, and it's gonna be producing shoes, for example, we know that machine's gonna be used more than just in that first reporting period or in that first year, right? So it's gonna provide economic benefits in the future. So management wants to pick the correct type of depreciation, because remember, there's the straight line. Then you have like the double declining methods, like time and a half and double declining, and then like some of the years, stuff of that sort, units of depreciation. So just stuff like that. So management wants to determine, because sometimes it might be expensed earlier within its life cycle and becomes less useful later on. So that might be you might want to do like a double declining one because you want to expense it earlier because you know it's going to produce more revenues early on. If it's going to be just straight out, then straight line would be the applicable type of systematic allocation you want. So pretty much, long and short, the expense recognition is the same as the revenue recognition. We just want to make sure we're matching revenues and expenses. So that, like I said, the fixed assets, they're gonna produce revenue. So we want to match those revenues with the expenses so we can get that true picture. A little more on conservatism. So once again, it's an approach that accountants use to avoid overstating net assets and net income when these amounts are uncertain and alternative valuations are equally possible. So it says here, results in the reporting of lower asset values or higher liability values when those values are uncertain. And also, accountants typically use a lower threshold for the recognition of losses than for gains. So what are we talking about that with conservatism? So would a company, say if we have a contingent lawsuit, like a contingent liability, that we're in litigation with the company, we're being sued, right? Maybe if we're an oil company, we've violated the EPA or something, so they're coming down on us hard, right? So let's say we have a loss contingency. We spoke of this a little bit on Wednesday. We're going to accrue the lowest range, right? Because we don't want to overstate that loss. If we have a best estimate, we'll use that one. Sometimes it might be in the middle, sometimes it might be on the bottom. But within the notes, we need to disclose the actual, both the high end of the range and the low end. But what we recognize in the financial statements is going to be the low end of it, right? Or the best estimate. When do we talk about when do we actually recognize a provision for loss, like recognize an expense and then a liability in terms of contingent liabilities? If it's two things. It's going to be estimable and probable. Okay, so meaning it's probably going to happen, I think more than 70%, 75, something like that, and estimable, meaning that we can estimate what the loss will be. So if that's the case, we accrue it. What about gains? Say, what if we're suing somebody else? Okay, now this time we're going to be on the other end of it, right? So we're going to be hoping to get money, right? How are we going to account for that? If we're applying the process of conservatism to financial reporting, if we get a gain contingency, not knowing if we're going to get it, should we include that gain like we do a loss?
Yes.
Only in the notes, if it would, but not in the financials, because to do so could over exaggerate the earnings or the financial position. So loss contingencies, if they're probable and estimable, we're gonna recognize those in the statements. Plus, with the note in the financials, gain contingencies we don't recognize because of this word right here, conservatism, because we want to be conservative, right? So it makes sense. So recognize loss ones, not gain ones. So conservatism is not a principle and is not advocated by the FASB. Instead, it is a practical approach accountants take to avoid misleading investors, lenders, and other creditors when valuations are uncertain. So think about it. If you were investing in a company, wouldn't you rather know the low end of what you can get instead of the high end? I mean, it's good to know both. You're going to know both in the notes, but actually within the performance of a company, of what the value of what you're buying, you would rather it be a more conservative approach to make sure you're not being misled, right? So that's why it's so important. Conservatism is sometimes described as prudence. Conservatism is prudent reaction to uncertainty to ensure, to the extent possible, that the uncertainties and risk inherent in the business situations are adequately considered. So pretty much all that's saying is they've just taken to effect all the little environmental forces coming at the company and all this stuff within making this estimate as to what should be noticed into the statements. Okay, so sources of information used in external decision making. This is going to cover learning objective number 5. So we see all information useful for investment, credit, and smaller or similar decisions, right? So we can see here that's spanning out over all these items, right? So all of this is going to be useful for investment and credit decisions. The financial reporting is just covering these four sections here. The area directly affected by existing FASB standards is just the financial statements, notes, and supplementary information. Basic financial statements, I think we know that, it's the financial statements and the notes, and specific statements is gonna fall within here. So let's just now talk about what they are in here just for a second. I think we already know what they are. Specific statements, obviously, financial position, net income. You have a statement of comprehensive income, and statement of cash flow, statement of shareholders' equity. What's the statement of comprehensive income? Because remember, we have the income statement, right? And that leads us from gross sales down to net income, right? And then if you remember, we have other comprehensive income. If you recall from intermediate, or I'm sorry, this is intermediate, so I forget. Other comprehensive income is items that are not going to be recognized in net income. It starts with net income, and then at the end of that, we get to comprehensive income. And it's items like changes in your pension plan obligations throughout the year, stuff with available for sale securities not selected with the fair value option. So that's just what the statement of comprehensive income is, just to throw it out there. Basic financial statements, we know that is just the main statements we just listed in the notes. So those are going to be the basic ones. The ones affected by the existing FASB standards, obviously, that's going to be the statements, the notes, supplementary information. And then we've heard of the management discussion and analysis, all that. That's affected by financial reporting, other information, analysis reports, economic statistics, news articles, stuff like that. So obviously, we can see how all of these different types of data can affect investment decisions, right? And we're just pretty much just narrowing it down as to what each of these things are applicable to up here. So, long story short, that's just a little summary there at the end here, so of the sources of information used for decision making. So that's the end of chapter 2. Is everyone clear on everything? Is there anything particularly difficult we covered? I think it's pretty straightforward. It's a lot of terminology and stuff within it. So, okay, so I'm going to go ahead and look through here for just a second here. Okay. So let me ask you a question. Would you rather get out of here early today, or would you rather just talk about some problems and stuff in class? And me just post them, just go ahead and post them when we get out of here, and you do it over the weekend on your free time, because you'll have time to do it. It's up to you. I don't care either way.
If you don't care either way, then I'll do it now.
You want to do it now? Okay, awesome. I would rather just get it over with myself personally, but I figured I'd be nice and just give you a choice. Let's see here. I'm actually just going to pull up the PowerPoints and just go back straight off that for our homework on these, just on some questions. I'm going to go to what I think is the most pertinent stuff on here. And for the anyone not here today, just follow along in this lecture here, and just do these problems and punch them in on homework 1. This is going to be homework 1 that we're starting here, because this is for chapter 1, the demand and supply for financial accounting information. Okay. So let's first thing, business activities. Let's just talk about the main types of business activities there are in a business. Let's just start with the first one listed here, financing activities. Let's go ahead and just jot this down, because then I'll just have you type this up and shoot it into the little shell thing once I create this. And let me keep up with the two. So business activities will be question number 1. So let's start with financing activities. What exactly are financing activities for a company?
Ways to raise money to support the company.
Right. So it's ways to raise money. What's another type of financing activity? We've talked about maybe bringing money in. What type of financing activities is cash going out?
I guess in, well, not investing, but the bonds.
If for bonds, repayment of bonds, that would be right. Repayment of bonds, the principal amount of the bond, right? The actual principal. The interest would be an operating expense, right? Because it hits the income statement. What about like if we have money from a bank or something? If we borrow from a bank, that's going to be an investing activity, right? Financing activity, because it's going to finance it. So pretty much, financing activities is going to be any activity where we're going to be taking out money from bonds, issuing bonds, okay, or issuing stock, and transactions with owners for the most part. If we pay the principal back on, like, say if we have a loan with the bank, if we make a principal payment, not interest. Interest is operating because it's the cost. It's an operating activity. So stuff like that is what a financing activity is, okay. What about investing activities? What is an investing activity for a company?
Well, it's something you put money into that you get money from over time.
Right, so that's one component of an investing activity. Say, like if companies have some free cash flow sitting around, they don't want to just hold the cash and just in the bank account not earn anything on it. So if they invest into other stocks and stuff of that sort, right, then that would be an investing activity, right? What about if they're investing in like some fixed assets, like the purchase of property, plant, and equipment? Wouldn't that be an investing activity because we've invested into a piece of equipment or a building or a property? So that's an investment, right? What could be some of the cash used in investing activities? So meaning making payments going out now, like coming out. But what about payments coming in? I'm sorry, we just talked about payments going out. What about payments coming in from investing activities?
Interest.
Not interest. Think about what we just talked about buying. So when we purchase something, what about dispositions? Meaning if we sell something, wouldn't that be like cash flows coming in from investing activities? Because if we accounted for that as an investing activity for money going out, then if we would make a disposition of a fixed asset, then wouldn't that consider money coming in investing, right? So stuff like that is investing. When we purchase like fixed assets or like investments in securities and stuff like that, like available for sale securities and stuff. That's what's going to fall into investing activities. Okay, now what about operating activities? What type of activities would we account for, like cash flows and operating activities? Think about like operating. What statement shows the operating performance of a company?
Income.
The income statement, right? Because that measures the revenues, expenses, gains, and losses for a period of time, right? So if that's the stuff that enters into the operating activities, if we're measuring the operating activities on the income statement, so wouldn't you think that probably the items that would appear that would hit the income statement, like interest expense, wage expense, payment to suppliers, and it's just operating cash flows, wouldn't that probably comprise these operating activities, cash flows coming in and out? Does that make sense? So operating is items that are going to hit your income statement, right? Investing is going to be like your purchases of fixed assets, like property, plant, and equipment, and selling stuff like that. Other investments that they make and available for sale securities and stuff like that. And then finances is going to be transactions with owners and taking loans out, issuing stock. Obviously, that's a transaction with owner, and like taking loans with banks. And if we pay a loan back on a bank, we remember there's two elements that's going to be effective there, right? When we pay a bank back on a loan, there's principal and interest, right? Where's the interest going to be reported when we're paying back a bank loan?
Would it be operating?
Operating, because that's an operating expense, right? Because that's the cost of obtaining that capital. The only financing part is because we borrowed a certain amount, right? But we owe them more back because of the element of interest in time, right? So only the base or the principal is the financing activity. That a lot of people get confused on that, and that they'll include the interest in financing, but it's operating. Okay, so that'll be question number 1 for chapter 1, is just explain the 3 different types of business activities, meaning what you would expect, what type of cash flows coming in and out you would expect to see on these business activities. Also, for the part B of number 1, tell me what financial statement you would find this information on. Which one would we find that on?
Would it be the balance? No.
You use the balance sheet to build this statement. You use the income statement and the balance sheet. Okay? To be able to build these. Statement of cash flows, right? Because remember, statement of cash flows is OIF. Remember, it starts with operating, investing, and financing. Okay, so that's going to be your different business activities and concerns of like cash flows, right? So these type of business activities are going to be presented on the statement of cash flows. So number 1 was, in terms of the business activities, describe the different types of business activities. Describe the different types of business activities and explain the types of cash inflows and outflows for each of the following activities. Okay, and then for that'll be A. Part B will be which statement can this information be found? So which financial statement can? Okay, so we got that part 1. The question 1's dealing with business activities. A is describe the different types of business activities. By that meaning, explain the types of cash flows that would occur in each category, the in and out. And then part B is which statement this info is found on. So we're good on that, right? We'll go ahead and we'll find us one more question from this, and then we'll do us 1 or 2 from the other one. That'll get us caught back up, other than quizzes. Okay, let's just say this for number 2. What is the name of the accounting standards body in America, in the United States? Who is responsible for promulgating GAAP or for establishing GAAP? What's the name of that organization?
Is it FASB?
the FASB, right? So, what about who is the organization responsible for developing or promulgating international standards?
IFRS.
That's the IFRS is like the gap part that FASB establishes. So that's what they promulgate, or that's the standards they create. So, but who is the body that develops IFRS? Starts with an I.
Oh, this isn't IASB, is it?
Yeah, it is IASB. What does that stand for?
International Accounting Standards Board.
Absolutely. Yep. So the FASB promulgates GAAP, right? U.S. GAAP, and ISB, the International Accounting Standards Boards, promulgates IFRS, right, which is International Financial Reporting Standards. So those are the two main standard-setting bodies, right? And they work hand in hand a little bit too. Remember, they've tried to converge these standards because they want to make them one universal standard is going to be their goal. So those are the two standard-setting bodies right there. So that'll be part A for number 2. What are the two standard-setting bodies that promulgate U.S. GAAP and IFRS? Okay, and you know when I say promulgate, that means just establish or create, right? So that's just another word for saying that. So that'll be part A. What two standard-setting bodies promulgate U.S. GAAP and IFRS? We know this. It is the FASB, Financial Accounting Standard Board, does GAAP, and the IASB, International Accounting Standard Board, does IFRS. Okay. Part B. Who delegates the authority to the FASB? They actually have this body has the authority. They're the ones that actually were given the authority to create GAAP, but they've actually given this authority to another body known as the FASB. What body did that? Any idea?
I can't think of it.
It's the SEC, right? Remember, the Securities and Exchange Commission is who they originally gave the authority. So they're the ones that are the enforcement agency, right? And they mainly deal with they want to have open and orderly markets, right? And make sure it's just one big fair playing ground. So for number 2 there, the first part, what two standard-setting bodies that promulgate what's two standard-setting bodies promulgate U.S. GAAP and IFRS? We know IFRS is from ISB and U.S. GAAP is from the FASB, and then we know that the SEC is the one who actually gave the right to FASB to be able to promulgate GAAP, right? Even though the SEC still enforces GAAP, right? So if you get sanctioned, it's going to be by the SEC, not by the FASB. The FASB doesn't have the power to sanction you. They just create the standards. If you don't abide by them, then the SEC sanctions you. Okay. Let's see. I think that probably. Yeah. Let's go ahead and go to chapter 2 here. I don't want to bore us too much. Drag it out. Okay, so that's chapter 1 we just did. Chapter 1 homework, okay. Chapter 2 Okay, so for number one on chapter 2, obviously I've got the answer up here, but what is the primary objective of financial reporting?
It's to accurately and unbiasedly report information about how the business is doing.
Right. So that's pretty much, they want to provide useful information to the external users, right? Is long and short what it is. They want it to be unbiased and stuff of that sort. So what is the primary objective of financial reporting will be number 1. And obviously the answer is given here on slide 14. It says provide financial information about the reporting entity that is useful to existing and potential investors, lenders, and other creditors in making decisions about providing resources to the entity. So it's pretty much you just want to be faithfully present your financial statements. Okay, now let's see here. Okay. What is the difference between accrual accounting and the accrual basis of accounting and cash basis of accounting? It will be number 2.
So accrual is things are counted when the service is delivered, whereas cash is when the money is received.
Right. So with accrual, we're more concerned when the events take place as opposed to when the cash changes hands, right? And that's sufficient of an answer for me because that makes sense. I know what you're getting. You don't have to do no long drug out answer from the book or anything. So we just need to know accrual accounting. We're accruing and deferring stuff, right? Meaning if someone pays us up front and we haven't satisfied our obligations, we defer it. If we satisfy our obligations up front and they don't pay us, we accrue it, right? So we're more concerned with what's happening currently other than when people are satisfying the money aspect of it. So what is the difference between cash basis and accrual basis accounting? Okay, we'll do one more and then we'll get out of here. How's that sound? And then I'll type these questions up in the relative chapter homework things and just type in their answers real quick on a document and just upload them in, and then I'll make sure we get our credit for chapter 1 and 2 homework. Does that sound good?
Yep.
Okay. Okay. Okay, let's talk about qualitative characteristics, okay? And specifically, I want to talk about the fundamental characteristics, okay, of financial reporting. And then once again, I have it up here because this is going to be something, this chart here, it can help you out a lot if you think about like relevance, faithful representation. So we'll just talk about this here. It'll help guide you when applying transactions and stuff if we remember this framework. So qualitative characteristics. Let's talk about, like I said, the fundamental characteristics. So what are the 3 elements of relevance? So if let's think if information is relevant, what did that mean? If it's going to be relevant, then we should be able to predict something off it, right? So it says here predict the value. So if it's relevant, we should be able to predict it because it's going to be relevant as to what we're concerned with, right? If we can predict something, we should also be able to confirm it, right? So it has confirmatory value. And materiality. Remember, what's materiality again?
Materiality is like when it makes enough of an impact that it's worth accounting for.
Right. So to omit it, it would skew the financial results and maybe mislead the investors, right? So we used the example of like we have $100 in a bank account. If we lose $1, we're not really going to account for that because we might spend more than $1 to account for it to get that information out there, right? So that's not very material. But if we'd lose half of that or $60, $70 of it, then we need to let them know, right? So that's very material. So that's materiality. To omit it, it would skew the results pretty much. So that makes sense why those components make up relevance, right? Because we can predict it, we can confirm it, and materialities too. So if it's relevant, obviously materiality comes into play, because if it's not relevant, then it's not material, right? So does that make sense, those components? So that'll be on number 3, the fundamental characteristics. So what are the 2 fundamental characteristics So part A of number 3 will be, what are the 2 fundamental characteristics of accounting? We know they're relevance and faithful representation, right? And then for part B, list the components of each of the fundamental characteristics. So once again, 3A is what are the 2 fundamental characteristics of accounting? And then list the components of each of the fundamental characteristics. So once again, the 2 fundamental characteristics is relevance and faithful representation. We already talked about relevance. That's predictive value, confirmatory value, materiality. Next, faithful representation. So if we're going to faithfully represent something, then let's talk about that. How would we go about doing that? So in terms of financial statements, if we want to be faithful about what we're presenting, we want to have a complete picture drawn, right? We don't want to omit like stuff that could be material and stuff of that. So we want to make sure that we're providing a complete picture for the external user. So completeness is going to be one of the components of faithful representation. Another thing of faithful representation, like if I'm reporting something, you don't want me to be biased towards your opinion over someone else's opinion, or needs over their needs, right? Because that's just not going to be fair to all users, because certain people are going to be more favored than other people. So that's just not right. So we want to be free of bias, right? So we want to be completely neutral, right? Another thing with faithful representation, we want to try to make sure that we're as sound as we can be in the financial reporting process to make sure that we try to eliminate as many errors as possible. If we find an error, we want to make sure that we correct that and it's notified to the shareholders, and that we make sure that we've made the changes to the reports, right? So we might have to amend our financial reports. So once again, those are the 2 fundamental characteristics of financial accounting. And once again, the overall objective is to just help out with the decision usefulness of financial information. Remember that all this stuff is subject to the cost benefit threshold. So if it costs more to put to put the information in the financial statements than the benefit that's going to be derived from it, then we're not going to record it, right? So all this is going to be subject to the benefit cost constraint. So once again, that'll be our chapter 1 and 2 homeworks there. I will go in later today for sure and type those questions up just on those. I'll have little homework links. So just, you can see here, I'll flip back real quick just so y'all can see to know where to look for it. This is my view. You can't see this yet because I've got the shell built, but I'll go ahead and you'll see it here right above chapter 1 quiz, right below chapter 1 lecture. That'll be chapter 1 homework. Then chapter 2 will be in the second week. So like I said, I'm sorry I'm having you backtrack to the thing. It's already built, so that's why I'm doing it that way. So I'll type these up. Just go in there and punch these in. Make sure you get these quizzes done as well, and then we will start chapter 3 on Monday and start getting into that. And I'll try to go ahead and have the homework and quiz built early next week. That's way it's available for you. So I hope everyone's understanding everything. I know it's been a kind of boring couple chapters, but it's an important couple chapters. So there's homework number 1 and 2. Go ahead. That'll get us caught up on that. Make sure you get your quizzes in. If you have any issues, let me know. And that's everything for chapters 1 and 2. And like I said, we'll start chapter 3 on Monday. I hope everyone has a good day and has a good weekend. And I will see everyone on Monday.